Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 202. Is it time to buy, sell, or hold? Cory, thank you for joining me on the show.
My pleasure. Thanks for having me.
And thank you for holding the fort down. For our audience who is watching this on YouTube, you can see I'm in a hotel room in Tulsa, Oklahoma, and Cory is in the office working away. But either way, it is hot wherever we're at. So don't feel sorry for me, Cory, or don't feel like I'm on some beach because it's steamy down here in Tulsa. And I'm down here actually playing in a golf tournament with a client. So we're having a lot of fun. I'm going to drink lots of water. Got my water here because it's hot. How are things in Kansas City right now?
They're hot. You know, I will say, though, the last few days have ended up a little bit nicer. I played tennis last night, and it ended up being a much nicer evening than I expected.
You know, it cooled off down here, too. I think Tulsa and Kansas City get similar weather. But we were out there playing our practice round, and by the last 4 or 5 holes, maybe I was so hot that I wasn't hot anymore, but I didn't feel hot anymore, and I wasn't dehydrated. I felt perfectly hydrated. I just wasn't that hot. So maybe we're getting used to it.
Maybe.
And then winter
only took till July, nearly July.
As soon as we get used to it, winter will be here.
That's right.
All right. So for today's topic, we wanted to talk about, is it time to buy, sell, or hold? As we've been having more and more client conversations, clients are asking me, Jake, is it time to get more aggressive? Should I sell and wait for this market to bottom out? Or do I just sit tight and do nothing? So Cory, why don't we talk about first things first? What do you tell clients when they're asking you, hey, Cory, should I get a little bit more aggressive? Should I use this 20% market correction or bear market to try to gobble up some more shares of stocks? What are you saying to that question?
There's 2 big factors at play there. One would be if someone has a target allocation of stocks to bonds, which most of our clients do. It's part of their financial plan that's driving things. Typically, the intent would not be to get more aggressive unless that was part of the plan. But I think a perfect example would be if somebody had, cash in bank accounts that they'd been waiting to put to work until the market dropped. I think using that cash to take advantage of buying at lower prices is opportunistic, right? It's the right idea. It's what we want to do.
Yeah, I agree with that. And as long as you stay within your allocation. So if you're and again, this show is not advice, right? So to get real advice, you need to set an appointment with myself or Cory. But the idea is if your target allocation is half in stocks, half in bonds, and like you mentioned, Cory, maybe you have some cash built up in your savings, or a lot of our clients have recently experienced what's called a liquidity event, meaning they've gotten a lot of cash flood in from a company buyout. And so if that's the case, we like to take that cash and buy it according to your blend. That's what Cory's getting at here. So if your 50-50 is at your target, we don't want to say go 80-20 all of a sudden, right? But what Cory's saying, if you already had some cash that maybe wasn't part of the portfolio and you want to blend that in and buy now, that's okay. There's one small caveat where I think it would make sense for someone to get more aggressive. And that's as long as you have at least, and again, this is a bare minimum of 5 years in bonds, and ideally 10 years in bonds. So let's say you're retired and you're spending $50,000 a year from your account. Well, the simple math on this says you need to have around $250,000 in bonds at a minimum, ideally $500,000. Well, let's say we're looking at your portfolio and today you've got $600,000 or $700,000 in bonds. Maybe you've been a little bit too conservative and now your appetite for risk has peaked a little bit. So that may be a scenario, but again, this is not investment advice. I would want to talk to that client first. I would want to plug in that allocation shift in the financial plan and show them what it would mean for their plan. And then I also would want to show them what it meant from a risk standpoint, right? Because you can't have your cake and eat it too. If you want to get more risky, you got to understand you could lose that money also. So But you're right. Good point, Corey. So if you've got some cash, it's a great time to blend it in. We think potentially, again, based on your plan. And then again, if you want to look at shifting your allocation, let's pull up that financial plan first, and let's make sure that you understand the risks associated with getting more aggressive.
Yep, I think that's absolutely right. One other quick point to make here, though, what is particularly compelling about the sell-off that we've seen in the market this year is that, you know, there are opportunities in the stock market. There's also a lot of opportunities in the bond market. With rates moving higher, I was looking at this recently, Jake. I've talked with some clients about it over the course of the last week or two. The 2-year Treasury yield on a United States Treasury this time last year was around 30 basis points, so 0.3%, you know, a little bit more than a quarter of a point. Today, the 2-year yield on a United States Treasury is over 3%.
Wow. I don't think I even realized that it's already up over around 3%.
And it was 3.5% about a month ago. And we've actually seen that come down some. And, you know, the 2-year Treasury is going to reflect a lot of expectations around the Fed raising the Fed funds rate. But yes, my point there is whether it's stocks or bonds, we've found more opportunities. And what I like for clients, especially our clients that are retired or approaching retirement, is that we are finding it easier. I don't know. I think easier is a appropriate word to use, to earn more income and interest on their portfolio, especially on the bonds after, you know, a decade plus of historically low interest rates.
Right. Historically, those bonds have been very boring, especially in, like you said, in recent times, and we haven't been able to earn that much interest. So to go out there and be able to buy, and again, those aren't fluctuating, right? So if you buy a bond, a 2-year Treasury bond today, and it says you're going to make 3%, and it's backed by the U.S. government, you can expect to make 3% a year, and then in 2 years get your money paid back to you, as long as the United States government doesn't default. Which that's a whole other topic for a whole other show. But again, we don't think that's going to happen anytime soon, certainly.
Yep.
Now, another thing to buy, so I'm glad you brought up bonds, is another thing to buy, and again, I've talked about this on previous shows, are I bonds. I bonds stand for inflation bonds. And again, we can't buy them for you. So it's something you've got to go out there and kind of take the initiative to do on your own. We could certainly kind of point you in the direction of where you need to go, but you got to take care of this on your own. But you can put up to $10,000 per year in these I bonds, and today they're paying around 9%. Now, there's a lot of stipulations. The interest is floating, so it changes every 6 months. You do have to lock up your money at a minimum for 1 year. And if you sell it within 5 years, you have to give up some interest. So there's some rules that you want to be aware of. But also, if you've got more cash and you don't want to buy stocks with it, I bonds or those Treasury notes, like you mentioned, Corey, would be some pretty good alternatives or something to consider.
Absolutely. And I found, you know, in supporting the research and trading group and the credit or fixed income research, you know, I've also found that if we're buying corporate bonds, investment grade corporate bonds, meaning high quality companies that issue them, we're finding now that bonds that mature, just bonds in 2024, 2025, 2026, we're starting to see those bonds yielding upwards of really between 4 to 5%. So again, that hasn't been the case the last several years. So while higher interest rates have caused volatility in the equity markets, I think it's important for clients to know that we're able to pick up a lot more interest and yield on the bond side in the midst of all this.
Yeah, that's great. That's a good point. That's absolutely, and again, that's another one of the reasons that you have a diversified portfolio and you want to have a bond component in there. So that's good. Now, what are you telling clients that are wanting to sell?
Unless it was part of their plan to sell stocks in their portfolio after they declined, 20%, 25%. Unless that was part of their plan before this move happened, I am encouraging clients to not do that.
Yeah, good point. So again, it wasn't in the plan, but a lot of people would argue back, and I'm going to play devil's advocate with you a little bit.
Sure.
Well, Corey, the plan has changed, and I'm nervous. The government, there's all this stuff going on. There's a war with Russia and Ukraine. Maybe they're a little cynical with their political affiliation one way or the other. So what do you say to that when they say, and we hear this a lot, that this time is different, or we've never seen this before? What are you telling clients that are asking you about that?
It's different every time, for what it's worth. But what I'm telling clients, though, is if somebody wants to reduce the exposure that they have to stocks, the big question, of course, always is, when do you flip it back in the other direction, right? In other words, if you exit the stock market, when do you get back in? I think, frankly, that probably getting out is more difficult than getting back in. I'm sorry, the other way around.
Right.
Getting back in is more difficult than getting out. It's easy to sell, but when do you buy back in? That's a big challenge in doing so. But I have been reminding clients that while this particular downturn is unpleasant, most of them are, the cause of each downturn that we've seen historically has been different each time. And part of our investment process and strategy is to maintain discipline through good times and bad. And it sounds simple, and it is, but it's not easy. So that's what I've been telling clients. And if somebody says, you know what, Cory, I hear what you're saying, it all makes perfect sense to me, but I'm still concerned and I want to do this or that, we'll help them understand, if we do that, what's the impact on their financial plan for the long term? Because for a lot of clients, we're planning for a 20, 30 plus year retirement, which is why there's stocks in their portfolio generally in the first place, because we need a growth component for a retirement to last several decades.
Right. And you're exactly right. And that's what's so critical for them to remember, is that if you've got bonds in there for 5 or 10 years, well, if you look back, again, bear markets happen on average every decade. And so this isn't the first bear market we've seen, and it won't be the last. So in somebody's retirement, if we, like you said, if we're planning for a 30-year retirement, they can expect to see 3 bear markets, right? And that's okay. But if you look back, and we've had some horrible things happen in history, obviously, with 9/11, the market's higher since then. The dot-com bubble bursting, the market's higher since then. The financial crisis, the market's higher since then. So again, you buy stocks not for short-term trading. That's very risky. It's a fool's game. That's not what we're doing. We're buying stocks so that your portfolio can grow, hopefully, faster than inflation. And inflation is hot right now. So that's why these I bonds are paying so much. But even if you buy the Treasury note, you're not necessarily keeping up with inflation. So you need to have a component in there that's going to grow and keep up, hopefully, with inflation. And then I love the clients, and I laugh at this just because I have so many conversations that say, well, I'm not trying to time the market, but I want to sell now, Cory, and then I want to buy back in when it's lower. It's like, well, you do
sounds like timing the market.
Yeah, you do want to. You've got it. So I would challenge our clients to, and encourage them to say out loud what they're saying. Like, I don't want to time the market, but I want to sell now and I want to buy back in when it's lower. Well, that is, by definition, that is trying to time the market. And I have never seen or heard of anybody that can do this consistently. So there's all these talking heads on CNBC, and I love CNBC, but there's all these talking heads on there, Bloomberg, Wall Street Journal, Barron's, whatever, claiming that you should sell now or whatever, and they don't know, because nobody has gotten it right consistently. I don't care who they are. There's nobody in the history of time that's got it right. Warren Buffett is arguably one of the best investors of all time, and he has made tons of mistakes. He's made a lot of mistakes, right? But he's also made some really, really good decisions. And the argument is, a lot of Warren Buffett's wealth was created in his 50s, 60s, and 70s, right? And because he's been investing for a long time, right? And so, again, you want to stay in. People that want to sell, you're right. We'll do it. As fiduciaries, though, it's our obligation to show you, hey, Mr. and Mrs. Client, if you do this, you are blowing up your financial plan. You're running the risk of running out of money. You may have to go back to work. You may have to move in with your kids. Just want to make sure you understand what's going on. And sometimes, Cory, if it's that severe, we'll draw the line, and we'll even resign the account and say, hey, if you want to do something that's dangerous, I don't feel comfortable being your advisor during this. And we will do that, because that's how much we care about our clients. And I hate to see people make stupid mistakes that literally cost themselves and their families thousands and thousands and thousands of dollars. So we're pretty adamant, but I don't take it personally anymore. I think I did earlier in my career. But now it's like, look, I get it. It's scary. Our process has been around for decades. You and I both studied at the University of Pennsylvania's Wharton School of Business. That's what we're using. They don't have to take our word for it. It's a time-tested process. And yeah, it's not perfect either, but we know, like you said, maintaining discipline is going to give us hopefully a better chance of executing on the financial plan versus just throwing everything out the window and letting emotions dictate our investment decisions. You gotta be careful.
Yep, absolutely. And I think it's important to point out too, though, because you mentioned, the talking heads on the financial networks and the stories that we read online, et cetera, because you mentioned all of that. I was just reading recently that one of the largest banks in the world, that has been publishing research about how, the market's going to drop X% further from here, and, giving people advice and ideas on how to trade it, et cetera, that at the very beginning of the year, 2022, in early January, the very same firm was publishing research that said, the party in crypto and stocks and everything else is far from over. My point is, they don't know, right? There are a lot of smart people that have a lot of different indicators and signals that they watch for in the markets, but no one does know. And, I find it fascinating that in late 2021, it's not as if all these people were on the television or internet, et cetera, saying, you better hurry up and sell all the stocks in your portfolio because 2022 is going to be a down year. They've waited until the market's dropped 20 to 25% to say, okay, the party's over, time to sell because it's going to get worse. And again, I don't expect somebody to be able to predict the future. I just bring all of this up so people know that if someone has a ton of conviction behind what's going to happen, just be careful and putting too much credence in that, because they don't have clarity into the future any more than you or me or anyone else.
Right. It's a good point. And it's also a quick side note before we go into the hold question is, it's important for our clients, at least, to remember that they don't own the broad market. So even though the market's down 20 or 25%, that doesn't mean their accounts are down 20 or 25%. And what I love is our individual stock picking. We've had some stocks that have actually done extremely well this year. And so I'm glad to show that to a client. Now, again, every client's portfolio is a little bit different because of their allocation or rebalancing, right? But broadly speaking, I feel like our performance has held up very well. And that's why we don't use index funds, because if you're in an index fund and you're hiring an advisor, well, you're down with the market, and you're down even worse because you're paying the advisor a fee. So I think individual stock and bond picking is really paying off this year for us and our clients. And I'm happy to show that to anybody that wants to take a look at it. So if you're a client and you want to compare your performance versus the broad market, it's easy for our team to pull that up and show you. Or if you're not a client and you're watching or listening to this and you want to compare your performance to ours, we can do that as well, because I think it's a good time, because it's easy. When the market's going up, everybody loves their advisor. Everybody thinks everything's great, but you should be really gauging the person managing your money when the market is down. Because again, if the market's up 22 and you make 21, that's, to us, that's kind of close enough. Of course, we always want to try to beat it on the upside. But if the market's down 20 and you're only down 10 or 15%, that's a huge deal. And for some clients, that's thousands and thousands, again, thousands of dollars. So that's when you want to peel back the onion and say, okay, Jake, I don't like that my account's down, but how are you doing relative to the index? I want to see, is what I'm paying you justified? Because if we were down worse than the market, that would be a bad thing. I wouldn't be happy with that. Clients wouldn't be happy with that. And they shouldn't be. So again, it's a good time to review your portfolio relative to what's going on out there. And we can't control the direction, but we can control, hopefully, how much we participate in that direction. And that's what we're looking to do.
Yep.
All right, good. I know we're running out of time here. So for the third one, hold. What are you telling clients that are just saying, Cory, I'm just riding the course. I trust you guys. I'm just gonna sit back and do nothing. What do you tell clients? What's your comments to that? Or what do you tell them?
Interestingly, I've been telling clients that in the type of environment that we find ourselves in right now, when it comes to trading, making portfolio changes, et cetera, when things are real volatile, when things are down, I believe that in general, less is more. And that, if you're trying to completely turn things over and make a bunch of changes, it can be a difficult environment to do that. So in that regard, I do think that less is more. I do think that if somebody is just staying the course and holding firm to allow us to go in and execute our strategy for them, I don't think that's the worst thing. But I just encourage people, don't bury your head in the sand in the midst of all this. You don't need to check your account every day, every minute, every hour. But you don't want to bury your head in the sand. You want to have an understanding of what's going on. And if there's tactically changes or levers to pull that make sense for someone's plan and portfolio, they should be evaluating those. But in general, I encourage people to not feel like they need to hurry up and do something different just because the market's pulled back this year.
Right, exactly. And I have two thoughts on this as well. And so I'm okay. Well, I'm not okay if somebody calls in and says, I don't want you rebalancing or doing any trading, basically holding by not following our process. So to me, that does do damage. So you don't want to like overstep and say, Jake, I don't want you to buy any stocks right now, even though I'm underweight stocks because they're down. I think that's a bad idea. So you got to be careful. So by holding, like you said, I like what you said as far as not maybe doing anything extreme, but you want to still buy if the process says buy, right? So you don't want to get away from that, because that's almost, or if not just as bad potentially as selling. So so let the process play out. Let us use math to dictate our investment decisions. I do like people holding off on maybe some major goals that were, they call it needs, wants, wishes. Maybe you've got this wish bucket of things that you've been wanting to do, and it's stretching your financial plan a little bit. So maybe you're going to buy a second or third home, for example, or maybe you were going to pay cash for something. Maybe we look at alternative ways in that financial plan before you just go out there and blindly make that decision. Now, typically, if you're going to retire, I believe it or not, like we have you set up to retire in all different types of market conditions. But I'm talking about, it may be okay holding off on stressing the financial plan if you can hold off on a year or two. Again, you don't necessarily have to, but I just want to think about that as a form of discipline. It's like if you went into work and you got a 20% pay cut, you probably wouldn't be going out there and buying a new home or doing something during that. You would wait for your salary to build back up, right? Or maybe you didn't get as big of a bonus as you were expecting, right? So it's just, I just want to encourage people to maintain discipline. I'm not saying that you can't go out to the movies or go on vacation. I'm just saying, let's be smart about some of those financial planning decisions that you're making, and let's review that financial plan. And what's beautiful about our financial planning software, actually, Cory, is that now that clients' accounts are down, that's all showing up in the plan. So the plan projections, we can look at it. If it says, hey, Cory, you were going to buy a second home at Lake of the Ozarks, you know what? You still have plenty of room in your plan to do it. Let's go do it. Then by all means, we'll do it. But if you say, hey, you know what? The market's down. We were going to mortgage it. Now you want to pay cash. So that actually is you're going to have to pull out a lot more money from your retirement. Let's talk about that. Let's look at some other ways. So we just want to make sure that we're running those plan scenarios and we're making good, disciplined decisions, and we're not just going out there and spending money regardless of what's going on. So you just want to be careful of that. But again, the first part of that, don't hold by disrupting the process. But if you need to hold off on maybe an extreme goal, something that was going to stretch your plan, maybe it's okay to look at that and say, you know what? Yeah, we don't know what the future holds, but I don't really need that Lamborghini this year, right?
Sure.
Or I don't need to pull out $200,000 from my IRA when it's down, right? I don't need to do that. Maybe I can get a mortgage, pull down just maybe 20,000 or 40,000 from my IRA, and then when things recover, then I can pull it all out and pay cash or whatever. So again, there's some other things we can do, but I just want to encourage you to I'm not telling you to stop living your life. I want to make sure that you're making smart decisions.
Yep, I do think that's very good advice for people, because if it's one thing from a financial point of view, but it's also another from a psychological. I know that clients that are retired, it's a challenge. It's difficult for them to take distributions regularly from their accounts while they're watching the market and their account values decline. And I think if someone has the flexibility in their financial plan, even if they have the flexibility to do something like buy a second home with cash or something to that extent, I still think they should just think long and hard about how they'll feel about that. I think if somebody sees, a big chunk of money come out of their account in the midst of a declining environment, for some people, it just causes a level of anxiety or concern that isn't necessary if, whatever it is that they're going to do is something that isn't a need, or it's something that they could consider doing it another time in the future when they might feel better about doing it. I think the psychological component of it is important too.
Yes, absolutely. Yeah, and thank you for sharing that. And I know we're running out of time here because you got to go run the team meeting. And I got to go play golf.
Hit them straight.
Do you have any closing comments as we wrap up the show, Cory?
No, well, actually I have one. You talked earlier, just a few minutes ago, Jake, about someone, if they said, I don't want to buy any more stocks to rebalance into the market. Remember that in order to sell high, we have to be willing to buy low.
Good. Yeah, that's good. And I always say that. And at the end of my emails, I got Einstein on there saying buy low, sell high. It's very easy to say, but people don't always want to do it. So you're absolutely right, Cory. Thank you for that takeaway. And thank you all for tuning in to Upticks. We really appreciate all the subscribers. Cory's got his show In the Money Insight. This is Upticks. Thank you all again. Thank you, Cory. And we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.